There are approximately 24 million millionaires in the United States right now. You have almost certainly passed one today. You did not notice, and that is not an accident. The UBS Global Wealth Report, released in June 2026, confirms something that researchers have been finding for 30 years. The typical American millionaire, not the billionaire, not the hedge fund manager on television, but the actual statistical millionaire living in your city right now, drives a Toyota, lives in the same house they bought 15 years ago, shops at the same grocery store you use, and holds almost none of their wealth in anything you would recognize as wealthy. The Millionaire Next Door, the research study, conducted across more than 30 years by Thomas Stanley and his colleagues, found something that almost nobody in the financial media has ever really taken seriously. At no point in 30 years of research did the typical millionaire hold more than 30% of their wealth in publicly traded stocks. More often, it was in the low to mid 20% range. The rest, the majority of the wealth, was somewhere else entirely. Where? That is what this video is about. Not the performance of wealth, not the signals, not the cars and the watches and the postcards from Maldives. The actual assets, the specific things that quietly wealthy people own that produce, compound, and protect their net worth while drawing precisely zero attention to themselves. There are 7 of them, and I would be surprised if you own more than 2. Asset 1. Index funds in boring taxable brokerage accounts held for decades without touching. Before I describe this one properly, let me first describe what most people think wealthy investors own. Most people imagine the wealthy investor as someone in front of multiple screens, tracking individual stocks, reading earnings calls, making concentrated bets on companies they have insider access to. Active management, information edge, complexity as a signal of sophistication. The data says something different. 40 to 45% of American millionaires built their wealth through career earnings combined with consistent investing in index funds. No business exit, no real estate empire, no IPO windfall. Just a maxed-out 401k, a taxable brokerage account holding broad market index funds, and compound growth left undisturbed for 25 to 30 years. The average millionaire's portfolio holds roughly 25% in stocks, primarily through low-cost index funds, 20% in real estate, 20% in fixed income, and the remainder in business equity, cash, and alternatives. There is no concentrated bet on a single name. There is no clever rotation strategy. There is a boring, diversified, low-cost structure maintained for a very long time. In the taxable brokerage account, the one that sits outside the 401k, outside the IRA, outside any retirement wrapper, is the one that almost nobody in the ordinary income bracket opens deliberately. It generates a tax event when dividends arrive. It requires no employer to offer it. It has no annual contribution limit. The quietly wealthy treat it as their primary long-term compounding vehicle alongside their retirement accounts, not as an afterthought. The boring taxable brokerage account, funded consistently, left alone, is one of the least visible and most reliable wealth-building instruments in existence. It looks like nothing from the outside. It compounds in the background for decades, and when it finally matters, it matters enormously. Asset 2. A small number of private businesses in unglamorous industries. The original Millionaire Next Door research found that one of the key reasons millionaires are economically successful is that they think differently about control. Many millionaires said that true diversification has much to do with controlling their investments, and that you can control your own business and private investments in ways you simply cannot control the stock market. The business that appears most frequently in millionaire portfolios is not a technology startup. It is not a venture-backed company with a pitch deck. It is a small, private, cash-flowing business in an industry that most people find too boring to enter. The average millionaire's home is worth $420,000. Comfortable, but unremarkable. The secret is redirecting money that could go to status symbols into investment accounts instead, and into private businesses that generate consistent returns. Commercial cleaning, pest control, industrial maintenance, specialty manufacturing, agricultural supply. The defining characteristics of these businesses are not glamour, but durability, consistent demand, thin competition from people who want to build something more interesting, in cash flows that remain broadly stable through economic cycles. The owner of a pest control business serving commercial contracts in a mid-sized city does not have a brand, does not have a social media presence, does not appear on any list of interesting entrepreneurs, and earns, in some cases, more in annual distributions than a senior partner at a law firm. The Capgemini World Wealth Report 2025 found that over 42% of millionaires earn regular income through dividends, interest, royalties, and property rental, income that requires no active time exchange. Royalties and licensing income are among the most structurally efficient of these because they require no ongoing capital commitment after the initial creation or acquisition. They simply pay, months after month, from a legal right nobody can see unless they look for it. The songwriter who wrote 3 moderately successful songs in 2001 and has collected royalties on them for 24 years has built something that looks invisible from the outside and functions like a perpetual annuity from the inside. Nobody knows. Nobody notices. That is entirely the point. The boring taxable brokerage account, funded consistently, left alone, is one of the least visible and most reliable wealth-building instruments in existence. It looks like nothing from the outside. It compounds in the background for decades, and when it finally matters, it matters enormously. Asset 2. A small number of private businesses in unglamorous industries. The original Millionaire Next Door research found that one of the key reasons millionaires are economically successful is that they think differently about control. Many millionaires said that true diversification has much to do with controlling their investments, and that you can control your own business and private investments in ways you simply cannot control the stock market. The business that appears most frequently in millionaire portfolios is not a technology startup. It is not a venture-backed company with a pitch deck. It is a small, private, cash-flowing business in an industry that most people find too boring to enter. The average millionaire's home is worth $420,000. Comfortable, but unremarkable. The secret is redirecting money that could go to status symbols into investment accounts instead, and into private businesses that generate consistent returns. Commercial cleaning, pest control, industrial maintenance, specialty manufacturing, agricultural supply. The defining characteristics of these businesses are not glamour, but durability, consistent demand, thin competition from people who want to build something more interesting, and cash flows that remain broadly stable through economic cycles. The owner of a pest control business serving commercial contracts in a mid-sized city does not have a brand, does not have a social media presence, does not appear on any list of interesting entrepreneurs, and earns, in some cases, more in annual distributions than a senior partner at a law firm. The Capgemini World Wealth Report 2025 found that over 42% of millionaires earn regular income through dividends, interest, royalties, and property rental, income that requires no active time exchange. Royalties and licensing income are among the most structurally efficient of these because they require no ongoing capital commitment after the initial creation or acquisition. They simply pay, months after month, from a legal right nobody can see unless they look for it. The songwriter who wrote 3 moderately successful songs in 2001 and has collected royalties on them for 24 years has built something that looks invisible from the outside and functions like a perpetual annuity from the inside. Nobody knows. Nobody notices. That is entirely the point. Asset 4. Their own time. This one is not on any balance sheet. It is not a financial instrument. It cannot be held in a brokerage account or measured in a quarterly statement. It is also, by almost any serious measure, the most valuable asset that genuinely wealthy own, and it is the one they guard most carefully. Think about what it actually means to own your time. It means you control which problems you apply your attention to. You control which relationships you invest energy into. You control whether you take the meeting, whether you take the call, whether you respond today or next week. You control whether you spend Tuesday morning at your child's school or in a conference room discussing someone else's priorities. The ordinary professional does not own their time. Their employer owns a defined portion of it. Their commute consumes another portion. Their reactive obligations consume most of what remains. The decisions they make with their discretionary time are made from the narrow residue left after all their obligations have been met. The quietly wealthy person has inverted this structure. Their income comes from assets, businesses, investments, royalties, rental properties that generate cash flow without requiring their presence for a fixed number of hours per week. Their time is not for sale, and because it is not for sale, they can apply it with a selectivity and a long-term orientation that compounds in ways that are genuinely difficult to measure, but impossible to miss when you observe the results over decades. Time ownership is the asset that makes all the other assets possible. It is also the one that nobody ever lists on the net worth statement. Asset 5. A professional network maintained deliberately over decades. Most people treat their professional network as a byproduct of their career. The people they have worked with, the contacts in their phone, the connections on LinkedIn accumulated without particular intention. The quietly wealthy treat their network as a primary asset, something built deliberately, maintained actively, and compounded over time. The original Millionaire Next Door research found that the most common path to wealth among self-made millionaires was not the spectacular opportunity or the lucky break. It was the steady accumulation of trust with a specific group of people over a long period. The referral that arrived from someone they had helped 15 years earlier. The partnership offer that arrived because a potential buyer had known them since they were starting out. The multimillionaire tier, households between $5 million and $30 million in net worth, typically has a financial advisor, owns multiple properties, holds significant business equity, and begins accessing private investments such as private equity funds and alternative assets unavailable to ordinary investors. Access to those private investments almost never comes through a cold application. It comes through a relationship. The fund manager who takes your call because you have known each other for 12 years. The off-market property deal introduced by someone who trusts your judgment. The business partnership offered to someone known rather than someone searched for. The network is not just a source of opportunity, it is a form of insurance. The person with deep professional relationships in their industry does not experience unemployment the way the person without them does. They make a phone call, the problem is solved. The compounding value of that over a 40-year career is incalculable and completely invisible to anyone looking at a net worth statement. Asset 6. Permanent life insurance used as a tax-advantaged savings vehicle. This is the one that generates the most skepticism from people who have not looked into it, and that skepticism is, in many cases, well-founded when applied to how it is sold to most people. But among the genuinely wealthy, households with between $5 and $30 million in net worth, permanent life insurance, specifically whole life and indexed universal life policies, is used in a specific and deliberate way that most ordinary policy buyers never encounter. Here is the mechanism. A permanent life insurance policy builds what is called a cash value, a savings component that grows tax-deferred, can be borrowed against tax-free during the policyholder's lifetime, and transfers tax-free at death. When structured correctly and funded aggressively, it functions as a parallel savings vehicle that is protected from creditors in most jurisdictions, grows at a guaranteed minimum rate, and provides liquidity without creating a taxable event. The wealthy do not buy permanent life insurance because they are afraid of dying. They buy it because the tax treatment of its cash value is structurally advantageous in a way that almost no other savings vehicle can match at their wealth level, where they have already maxed every other tax-advantaged account available to them. The policy sits on no public register, it generates no visible income, it appears on no list of assets that anyone would associate with wealth. It compounds quietly and pays out when it is needed in the most tax-efficient way the law allows.
It is exactly the kind of asset that the quietly wealthy own and almost nobody else knows to look for.
Asset 7. Real estate held for cash flow in markets nobody is talking about. This is not the real estate that appears on property shows. It is not the renovated Victorian in a gentrifying neighborhood that someone bought, transformed, and sold at a spectacular profit. It is not the beach house. It is the 4-unit apartment building in a second-tier city with a 7.5% cap rate. The small strip mall in a stable suburban market, anchored by a dentist and a nail salon that has been there for 19 years. The industrial unit leased to a logistics company on a 10-year commercial lease. The world's millionaires hold an average of 19% of their portfolios in real estate, and those holdings have remained flat as a percentage even as their overall wealth has grown, suggesting this is a deliberate structural allocation rather than an opportunistic one. The real estate that the quietly wealthy hold is not selected for its story, it is selected for its cash flow relative to its price, cap rate, net operating income, vacancy rate, lease duration. These are the metrics. The neighborhood prestige is not the metric. The architectural character is not the metric. The only question that matters is, does this property generate consistent, sustainable income relative to its purchase price in a market stable enough that the income is unlikely to be disrupted? The answer to that question is most commonly found not in the hottest markets, but in the markets no one is currently excited about, the markets where there is no competition from people who want to own a story, where the buyers are calculating rather than emotional, where the yields are intact because the glamour is absent. Nobody at a dinner party asks the quietly wealthy person about their strip mall in Columbus, Ohio. That is exactly why they own it. Here is what all 7 of these assets have in common. None of them show up in photographs. None of them are visible at a social event. None of them would make an interesting caption on any platform that rewards performance over substance. None of them require the owner to explain or justify them to anyone. In the United States, nearly 79% of personal wealth is held in financial assets, stocks, retirement accounts, brokerage portfolios. The everyday millionaire is largely confined to public markets. The elder siblings, households between 5 million and 100 million, have access to private equity, private credit, co-investment opportunities, and alternate asset classes that have, over the past decade, consistently outperformed public equity on a risk-adjusted basis. The gap between the everyday millionaire and the quietly wealthy is not primarily an income gap, it is an asset class gap. It is the difference between the assets that are visible, marketed, and accessible to everyone, and the assets that are private, unadvertised, and accumulated through relationships, patience, and the deliberate avoidance of anything that requires performance to justify. 94% of millionaires live below their means. This is the defining characteristic. They earn well, but spend even less than they earn, consistently for decades. The money saved by not performing wealth is the money that funds the assets nobody can see. The average millionaire's home is worth $420,000. Their car is a Toyota or a Honda. Their neighborhood is the one they have lived in for 15 years. Their wealth is in a taxable brokerage account, a private business, a royalty stream, a permanent insurance policy, and a cash-flowing property in a city that does not trend on any platform. You probably passed one of them today. You did not notice, and they are perfectly fine with that.